All kinds of things going on. Wow, what a week it has been. So much to digest, so much to think about as we go into the second half of the year, Alex. Yesterday was about central banks. Yesterday was about surprises. Today is about the data. And the PMIs, particularly out of Europe early this morning, having an absolutely enormous effect. Massive bid coming back into the bond market. Take a look at what is happening here. Currencies get trashed. The Norwegian kroner leading the charge, but the euro's down hard. And equities, as you say, wow, what a week it has been. A bad week for European, maybe in global stocks as well.
The only thing that's not having a bid is the front end of the UK gilt curve. Sorry, that's still a tough spot there.
We are different and beginning to increasingly feel different, feel very different in terms of the narrative here. The Bank of England, wow, we're going to talk about policy mistakes later on. They've got a really, really big challenge.
Yeah, exactly. So anyway, so we'll take you that for the next couple hours as well and get the view from many different areas from the C-suite as well as emerging markets.
Okay, let's talk a little bit about what's happening in terms of the data. Let's figure out what's going on with these numbers. We've just seen the US data drop on the PMI front. We got the European numbers a little bit earlier on, and boy, were they ugly. Mike McKee joins us now to go through all of the data. Mike, compare and contrast the data for me.
Well, if you're looking at the U.S., it's not ugly, but it's not pretty. The European numbers are ugly. U.S. is down as well in all categories. The manufacturing PMI comes in at 46.3 after 48.4. That is the lowest since last December. Services at 54.1, down from 54.9, and the composite is 53, down from 54.3, so measuring a definite slowdown in the United States. And then when you do go over to Europe, you see some really ugly numbers in manufacturing. All of them down, all of them in the mid to low 40s with no kind of optimistic outlook there. And services in France falling below 50 and falling, although they're still in the 50s, in Germany, Eurozone, and in the UK. Actually, the UK manufacturing is 46.2 and the services number 53.7. So you're not that different in the sense that the economy looks bad there from a PMI stance, Guy. Well, we still love you. I mean, it's not, you may be different.
Oh, excellent. Good. I'm so glad to hear that.
It kind of depends on the day. Let's be totally honest with that.
Alex does have a fairly downbeat view of the UK economy, though, I have to say, and she repeats it on a fairly regular basis.
I do. Hey,
but I'm glad that I'm still loved at least.
The data speaks for itself. That's all I'm saying.
It does.
Okay, thanks, Mike. Really appreciate it. All right, let's get more on this. Our question of the day kind of wraps all this in. Are the PMIs that we got today pointing to a policy mistake from central bankers? Joining us now is the man behind the data, Chris Williamson, S&P Global Market Intelligence Chief Business Economist. That divergence, services and manufacturing keeps widening. Is this pointing to a policy mistake at this point, Chris?
Hi. Well, certainly some very disappointing numbers, as you say, across the board, most notably in Europe. We're seeing growth weaken. So in terms of policy mistakes, I mean, policy is designed to make demand weaken, and that's exactly what you've got, plus a bit more possibly. Eurozone growth is stalled in June, and it's weakened quite markedly in both the US and the UK, as well as in Japan in June. You've got a manufacturing sector that across those economies is now facing its deepest downturn since 2009. That's just getting deeper and deeper. Service sector, which was a big growth driver in the spring as we saw resurgent demand for services like travel and entertainment, tourism, that's beginning to show signs of weakening as well now as that impact of higher rates and the cost of living takes its toll.
Chris, this may be the impact of policy, but policy is likely to continue to tighten. Should the ECB be continuing to tighten given the data you are giving us?
On these data alone, there's quite a clear answer no. If you look at the new orders data, next month you should see output in contraction. So the start of a downturn, possibly a recession. If you look at the price data, that's come down very, very sharply. Even the data that correlate closely with core CPI are coming down very steeply, suggesting that you're going to get CPI down to maybe 3% by the end of the year if you continue to see this sort of progress. So, and this is not just manufacturing prices, it's now service sector inflation rates as well, which, yes, they're elevated, but the speed with which that inflation rate is coming down is amongst the fastest that we've ever seen with these surveys.
Yeah.
So this is quite a marked inflation slowdown.
But well, at least here in the U.S., prices charged for services went down a little bit, but their input prices are still rising. So it's not all equal. So I'm wondering, if we do continue to see hikes, Chris, what happens to manufacturing and the services spread? Like, does it keep getting wider because manufacturing falls, or at some point that bottoms and services collapse?
Yeah, I think you'll see some easing of the manufacturing downturn, because at the moment you've got a big inventory drawdown as companies are just getting rid of their excess stock. That's going to play out, and you should see some pressure coming off manufacturing output as the year goes by. Service sector, I think you're going to see more weakness. We've had the big surge in travel and so forth come through in the spring. That's going to peter out as the year goes on. So you'll see some closer alignment of manufacturing and service sector numbers, but my suspicion is they're going to be aligning lower. So the share of the pie for both sectors is falling.
Alex, I can't quite bring myself to ask this question with relation to the Bank of England. So can you ask it?
Sure. What? Oh, I'm doing. Oh, I see. I'm doing it for you.
No,
I see what you're saying.
Glad we're on the same page here.
Okay, that's good. Okay, so Chris, to that point, the market's pricing in a terminal rate of 6.25% for the BOE now. We haven't seen that since 2008. How bad is it going to look in the UK right now, or in the next 6 months?
Well, yeah, so the UK is an outlier in terms of this, especially service sector price inflation is higher than the other economies in the PMIs and, of course, in the official data. And the problem that the UK has, of course, is the policy response was not as aggressive as it should have been earlier on. But also, of course, we've got the worst of both worlds. We've got a very tight labour market, as well as the energy price inflation and food inflation that everyone else has seen. So we've got the worst of both worlds.
Is the policy mistake, I'm assuming, was already made. We're pointing to a policy mistake that will be made now, but that is a supplemental policy mistake. As you allude to, Chris, with all these central banks, the mistake was made in not tightening early enough, and that is the effect that we are now seeing.
Precisely, yes. They're having to do this now because they didn't do enough before, and it's going to cause a recession by the looks of things, especially in Europe. The half-point hike yesterday by the Bank of England, that should have been earlier.
Okay, I just want to point this out. The UK is worser of both worlds, guys. So this is not me ragging on the UK. This is like from Chris Williamson saying you got the worst of both worlds. I'm just saying I'm sorry.
The British papers this morning, painted a really ugly picture of the mistakes that the Bank of England has made, and those mistakes leading to a significant sort of confidence issue surrounding the Bank of England's ability to navigate this. So the bank has major problems. Chris, the UK is likely to face a significant recession. What are the recessions likely to look like elsewhere? And are recessions the only way now, you think, and are we seeing evidence of that to get inflation out of the system?
I think the Eurozone is facing the most immediate terms of recession, then the UK and the US to the least extent. The US seems to be holding up better, especially in the service sector. Labour markets are strong, right? So I don't think on the face of what we've got at the moment, recessions will be deep. You've got strong labour markets that are going to support growth, and strong wage growth, which is going to mean those recessions are relatively mild.
Which is interesting because in some ways the policy mistake, if you were going to make a policy mistake and you were going to see the clearest evidence of that policy make, it would be runaway unemployment. And what you're suggesting is that we're unlikely to see that. So in some ways, actually, the policy mistake is likely to be relatively minor compared with what it could look like. Chris, we've got to go. Great to see you. Thanks for sharing the data with us and bringing us analysis. We really appreciate it. Chris Williamson, S&P Global Market Intelligence Chief Business Economist. Okay, let's move on and talk about what we're going to be doing next. We're going to have more on our question of the day, our PMIs pointing to a policy mistake. Lisa Sallet, Morgan Stanley Wealth Management CIO, joining us next. This is Bloomberg.
I realize that they made a big move over in the UK, and thank goodness we're in the US as versus the UK. They have a bigger problem than we do on inflation. We have always said that they will continue to bring inflation down to a level, maybe it's 3 or maybe it's 2, and if we take the Fed at their word for 2%, it's going to be higher for longer, and we have said that at Federated Hermes for a very long time. The question is, will they call victory at 3%? Because if they do, we may get out of this with just the rocky landing, but if they don't, they will tighten into a real recession.
That was Linda Dussel of Federated Hermes on Bloomberg TV earlier today. So our question of the day is, are PMIs pointing to a policy mistake? I want to bring in Lisa Shallett, Chief Investment Officer at Morgan Stanley Wealth Management. This comes on the heels, obviously, of the PMIs that continue to roll over. We know the story. Services holding up okay-ish, but the manufacturing sector keeps getting hammered. Are they pointing to a policy mistake, Lisa?
I think it's too early to make that determination in the U.S. I think we're, closing in on the end of the second quarter. There are some GDP Now surveys that are saying U.S. GDP on a real basis is going to be approaching 2% in the second quarter. We still have a labor market that, while it's showing some initial cracks off of historic lows, is still really pretty healthy. And so I believe that the threats that we're not out of the woods on inflation are legitimate, and that, under Jerome Powell's leadership, I do think that the jawboning that he's doing, the hawkish tone that he's taking, is the right one at the current moment.
Lisa, I guess we should probably, good morning by the way, it's Guy, I guess we should probably define what a policy mistake actually looks like. To my mind, it looks like an uncontrolled rise in unemployment. The labour market becomes unhinged in completely the opposite direction, and we can't fulfil the other side of the mandate for the Fed, full employment. Am I going along the right lines there? And if we look at the labour market right now, it seems like we're miles away from that.
Exactly. That's why I agree with you. I think that there's been a desire because of the way the Fed has been so proactively the saver or the savior of the markets and of the business cycle over the last 14, 15 years. There's this, belief, I think, among some portion of the investing public that, the Fed is always making a mistake if they're not rescuing every downturn in activity. But to your point, in the aggregate, the Fed's got to follow their mandate. Their mandate is getting to a 2% inflation target. We are not there, and doing their best to keep, the labor markets near full employment. And there's pretty good evidence that we're still pretty near full employment. Mm-hmm. So I think it's way early to declare a mistake, and I think it's way early to declare that if the Fed stays at these levels or even goes in another 25 to 50 basis points, that a recession is inevitable. I don't know that we know any of that.
No, we don't. Which, Guy, that makes it so much harder to know what to do if you're investing in the short term, right? Sell tech, sell stocks, buy bonds. That's clearly the trade today. But it's like, how much of that is actually, let's rejigger this based on this week that we've had, and how much of that is, look, we're 1 week into the end of the quarter, then we're going into the first half of the year, and then we're going into summer, and we're going to rebalance some stuff. I don't know, Guy.
I think that there's a positioning story. I think there probably is a liquidity story that came out of the SVB banking crisis. The Fed pumped a load of money into the system. Maybe that was what blew up the baby bubble in tech. There's a whole load of things going on. And if you still believe that the Fed maybe has got further to go, are you still willing to make the move into bonds at this point? I don't know. Certainly if you look at European bonds, some really tricky trades here. Lisa, how do I position my portfolio for the second half of the year, given all of those different factors that I need to think about?
Look, I think this is where one of those times where you really just have to take a deep breath. To your point, you need to rebalance, which means reflecting on the last 6 to 12 months of performance, how portfolios may have gotten out of line with your target allocations, with stocks, at least American stocks, so profoundly outperforming at least, the cap-weighted index and some of the growth stocks. And you do need to rebalance. And for us, it's about looking at risk-adjusted returns. And so we still believe from here that American stocks, again, as measured by the index, are very vulnerable to a 10 to 15% correctional pullback, given that expectations and valuations are quite rich. Whereas in bonds, we do think whether you're talking about the front end of the curve where you can get, yields close to 4.5%, or you're talking about investment grade credit risk where you can get, maybe 5.5%, 6% with kind of the asymmetry of potentially seeing falling rates in the next 6 to 12 months ahead of us if the Fed is moving to a cutting or accommodative position. So
Lisa,
we have a preference for bonds here.
So Lisa, just in terms of your equity trade, why didn't we hit that drawdown back in October? If October in that low was already looking at sort of the mess in the economy we were going to see this year, why aren't stocks discounting 2024 when the Fed will probably cut and looking through the bad cycle? Why is that not the case?
Well, look, it may be the case, right? The wisdom of crowds is priced in the markets. All I can give you is the wisdom of Morgan Stanley. And our wisdom suggests to us that when we look at the data, while people may psychologically be saying that they're looking through bad news, there was no bad news ever actually forecast. You look at consensus estimates, the expectations for sales per share in the S&P 500 has continually gone up straight through expectations for 2025. Earnings expectations, while they took a bit of a dip, over the last 6 months have already rebounded. And so, we're looking at almost a hockey stick recovery as we look at the year-over-year growth rates in Q3, Q4, and into 2024. In fact, year-over-year, current consensus is pricing a 14% year-over-year EPS growth. So, it's hard to believe people are seeing through something they haven't actually ever really, penciled in.
Lisa, great to catch up. Have a great weekend. Thank you very much indeed for your time. Lisa Shallett at Morgan Stanley Wealth Management. What are we going to be doing next? We're going to go back to the tech sector. Meta announcing that it's going to shut down access to news on Facebook and Instagram in Canada. Follows a similar move that we've seen obviously in Australia. We're going to talk about what the implications of all of this is next. The startup is going to come to you from London today. This is Bloomberg.
It's 22 past 7 on the West Coast. Want to get to the startup? We cover all the top tech stories from the Bay Area and beyond. As Silicon Valley starts its morning, joining us now, though, from London is Alex Webb of Bloomberg Quick Take. We want to talk about Meta, and potentially they won't be able to link to news without paying for it on Facebook and Instagram. Walk us through what's going on here.
So what we saw a few years ago is Australia introduced some legislation that essentially forces the big social media platforms to talk to the news publishers and try to find an agreement that will mean they have to pay them in order to let links to their stories be posted on their platforms. And they said they're going to pull news from their platforms in Australia. In the end, they came to an agreement. What we're seeing now in Canada is something similar. It sort of seems as though Facebook or Meta is being a little bit more serious about it this time and is going to stop news publishers being able to publish there, to their stories to be published there. They say that news publishers need this link. They need to be able to get traffic from social media. Publishers say, yeah, but we don't want to have to do it for free.
Okay. The world has moved on since the Australia decision. We are now dealing with the Canadian decision. Is the reason why Meta can play hardball is because the way we consume news has now significantly changed?
That is where it gets really interesting, right? And why this is a particularly interesting test case. Because a few years ago, 3 years ago, really is when the rubber hit the road in Australia.
Yep.
Instagram and TikTok weren't quite as big as they are today. And these are not on the whole platforms where you go to see a link that you click and then go elsewhere. You see a lot of native content, videos, photos that are posted by people, often videos of someone commenting on the news without necessarily seeing the original news story itself. And of course, if a news publisher decides to create a video that it publishes entirely on TikTok or Instagram, it's a very different issue from someone else posting a link to one of their stories. So that's why I suspect Facebook might, or Meta might be saying, well, actually, we're just going to pull those links and it may not make a huge difference to our platforms because the nature of social media consumption has evolved.
So just pretend that they did wind up paying news sites for it. How much in theory would that actually cost?
So the estimate that is being published certainly by Bloomberg is that it's in the order of $200 million US per year in Canada. Now, you can extrapolate that globally. If that were to be in lots of different countries, it starts to get quite meaningful. It's still, probably a rounding error in comparison to Facebook's, broader gross margin, and Facebook has something like a 70% gross margin. So it's something they could afford to do, probably something they're still loath to do.
The bigger picture here is, there was we all work in the news, so we've seen this happening. Over the last few years, you've seen a huge move in the way that people consume or gather news towards these social media sites. Has that now come to an end? And I guess the kind of the hopeful question is, does it therefore go back to the more traditional way that people consume news, or has that ship now firmly sailed?
There's sort of a philosophical thing here to do with platforms, right? What platforms did when they started out, this pertains to news, it also pertains to Amazon. The example you'd use, if you use Amazon as an example, and you use Toys R Us. Toys R Us said, we're going to we're going to make our stuff purchasable through Amazon.com. They're going to run all of our back end. To begin with, people were trying to buy a toy. They would go to the Toys R Us website. Increasingly over time, they just go to Amazon, and people forget that Toys R Us exists. Toys R Us goes bankrupt. Now, I'm not saying the news organizations are definitely going to go bankrupt as a consequence. We've seen the brand equity shift from the big news brands towards these social media platforms, so people don't necessarily anymore go, I'm going to visit the New York Times website. They instead go, I'm going to go to Facebook.com. And find a link, and it might be New York Times, it might be a bloke in his mum's garage in Idaho, who knows, and that brand equity now increasingly resides with Facebook. So the suspicion might be, therefore, that the ship has sailed. I hope that wasn't too convoluted.
No, it's perfect. Toys R Us, perfect. Alex, thank you very much indeed. Alex Webb of Bloomberg Quick Take on what is happening here. We'll watch this space. We'll see what happens with this story. Coming up, China's lackluster recovery, dredging up the gloom around the metal market. We're going to talk to Ivanhoe Mines founder, Robert Friedland, about what his outlook looks like. He is a long-time mining executive. He's got a pretty good view of what the story looks like. He's joining us next. This is Bloomberg.
right, we're about an hour into the U.S. trading session. Equities trading pretty heavy, particularly tech down over 1%. Abby's tracking the moves for us. Abigail?
Yeah, this wobbly action that we've been tracking all week, Alex, really does seem to be translating here into a bit of a sell-off. The S&P 500 down about 0.7%. Its worst day in about a month. On the week, down more than 1%. Its worst week since early March. But you can see the bigger declines there for tech, NASDAQ 100, and the stocks down more than 1%. And NVIDIA down 1.7%. So this AI boom that we've been seeing, some more air coming out. I want to focus, though, on small caps. If we go into the Bloomberg terminal, the Russell 2000 is doing something pretty interesting. Now, this is a busy chart at first glance, but I think it's an important one. In white, we're looking at the Russell 2000. Here is the year-to-date range. The S&P 500 recently broke out of its range. But take a look at both of these indexes below the 10-day moving average. That's a real near-term gauge. The Russell 2000's 10-day moving average rounding down, breaking down. The S&P 500 below its 10-day moving average. I believe we could see the S&P 500 follow the Russell 2000. It seems very clear to me that the Russell 2000 will go back to the bottom of its range. It's not clear what kind of decline that means for the S&P 500 is ahead, but I would say 5 to 10%. So this is probably a bearish near-term chart, but overall sideways. As for some of the other asset classes on the day, not surprisingly, we have a rally for bonds yields. For the 2-year yield and the 10-year yield are in. The Bloomberg Dollar Index up 0.4%, pointing to this haven bid. And even with the dollar up, gold is higher, really again pointing to the haven aspect of the day's trading. Finally, rounding it out, commodities, they are down too, down another day in a row. And what I want to point out here is on the year, you have the S&P 500 up more than 10%, but take a look at the Bloomberg Commodity Index, down more than 10%. When you have that kind of divergence, especially, Guy, right now, we're all waiting for this recession or wondering where it's going to be. Commodities, those natural resources, the fact that they're down so much in everything that we use may suggest that perhaps it is still out there and it's showing up in commodities, and maybe this divergence between the S&P 500 and the Bloomberg Commodity Index could end, Alex, with the S&P 500 coming in to meet commodities.
Yeah, and the commodity sell-off was kind of ugly, right? You got WTI with a 68 handle now. Copper's also rolling over, aluminum. And part of the issue, by the way, thank you, Abigail. Part of the issue, Guy, is kind of what do we make of China in terms of the actual underlying demand when it comes to the metals, right? So Jeffries had a note out talking about how China-centered demand for metals that powered a super cycle in the past is now over, and that China could actually be more of a tailwind than a headwind for demand over the next decade. No, sorry, headwind, not a tailwind.
Headwind. Yeah.
Headwind bad, tailwind good. There you go.
I've got the tailwind. I'm going to compare and contrast your note with one out from Beata Manthi over at Citi, which I thought was really interesting. The China trade has played out in Europe basically via the luxury stocks, not via the mining stocks, and she thinks that is going to flip. It's interesting, it compares and contrasts with the Goldman Sachs note, which is kind of came out recently, which takes the opposite side. Basically, they're talking about over at Citi about the fact that metals and mining are likely to go forward in a reasonably positive way from here. It's a trade that hasn't worked, metals and mining, some of the worst performers year to date in Europe. But what the sense seems to be, Alex, is that China policy is going to change. And it's going to be infrastructure directed, and as a result of which you are going to see demand picking up. This at the same time as sentiment bottoms out, as a result of which you're going to see that underperformance gap starting to close. And the line also goes that the metals and mining is going to serve as a nice hedge that actually China does do better. The view certainly now seems to be quite downbeat on China, and maybe actually the pain trade on China is up.
Maybe. Or is the green trade and the energy transition really going to be in Europe and the U.S. and not China? So the whole point of this conversation is the analysts just do not agree on the China growth story and whatever stimulus. So we wanted to get that view from the C-suite now. Ivanhoe Mines is a Canadian mining company with copper, zinc, nickel projects in the DRC and South Africa. Its chairman and co-founder is Robert Friedland, who has over 30 years of experience in the sector, and in December 2021 was inducted into the American Mining Hall of Fame, which I did not know that they had. So congratulations on that one. Robert, good to see you. Thanks for joining.
What a pleasure. Thank you.
Okay, so analysts can't figure it out. What do you see on the ground in China? Tailwind or headwind for
I was
the
there
metals?
2 weeks recently, and the Chinese are ebullient about their situation. So the closer you get to China, the more bullish they are, and the farther away you are, talking heads talk it down.
But are they ebullient on, like, we're going to go build a skyscraper and houses, or they're like, we're going to go buy a Gucci bag?
They don't have inflation. They have cheap commodities coming from Russia. So they've got a giant tax cut with cheap energy, cheap metals, cheap everything. And so they're out of jail. You know, they've all been under lockdown. I find my Chinese friends to be very bullish on the future.
So if I look at the future, though, for copper, if we wrap that in then, 8,400 on the LME. Should it be trading at 8,400 based on what you just said about China?
I don't really think very much about short-term fluctuations. We know for sure that metal will fluctuate in price. We're in the mining industry. We have to take a very long view. We have to find a way to mine it sustainably at very low cost.
Okay. Morning, it's Guy. That is fine. You've got to reduce the cost. You've got to do it sustainably. You've got to ultimately look at a more positive picture going forward. I hear what you're saying about not wanting to track, Robert, the short-term fluctuations. But your sense is that structurally, demand for copper is going to increase. We are going to go through a big electrification program. China ultimately probably will come back. Your sense is that long-term, the price of copper is likely to rise and rise significantly.
Of course. I mean, you've just ignored India. India's got more people than China now. It's growing just fine. We've got 7 billion of us on this little planet hurtling through space. We want to electrify the world economy. That is dependent on the metals we mine. And more importantly, we have remilitarization all over the world. So national security now demands that a lot of governments are remilitarizing. What do you think an Army, Navy, or Air Force are made out of?
Copper, metals, those things.
Exactly.
But this is where I think the short term and the long term line up, and the same thing happens in the oil market. So you could see the bullish view for copper and why we really need it, but the short term price signals don't tell you that. So when you're making investment decisions, doesn't that create a real problem?
Yeah, we're underinvested in this industry. Mining as a percentage of the S&P 500 is in valuation the lowest we've ever seen, and yet physical inventories of a lot of these critical metals are the lowest we've seen in decades. So in time, you're going to have a real massive appreciation when we are requiring these metals. I think we'll toss out the MPV models. A war, for example, demands that you have the metal immediately. All you have to do is see what happened to the real price of copper in World War I and World War II.
Yep. Robert, we've got a graphic up at the moment showing where you mine the copper. DRC. South Africa. These are tough places to operate right now. South Africa in particular has a significant problem with energy. We've got a big election coming up in 2024. What is your sense of the stability of where you are mining right now?
We've never had a problem. We've been in South Africa 30 years. We've been in the Congo 30 years. Our costs are denominated in the South African rand. Our revenues are in dollars. We're allowed to generate our own electricity now in South Africa, so we're building an all-electric mine. We're putting up solar power. And so we've got a former president of South Africa, former deputy president of South Africa on our board. And we're the best story in the mining industry there, so we're enjoying it. So we
do you think that that's going to change? This is a country that has major unemployment issues. It has, aside from you, maybe your electricity generation is fine, but the country has a significant problem with that. There is a distinct possibility that we're going to see a change of government in that country. Were we to do so, do you think you would be as well sorted as you are now?
Yes. We've reinvented mining. We have women in prominent positions. We work well with the local community, and every government needs good news. I'd remind you, we have both the Chinese and the Japanese as major shareholders in what we do. So we have a type of political stability that we sort of ignore these negative factors because you've got to mine these metals somewhere. Absent that, the lights won't go on in this magnificent studio.
Absolutely. Yep. You got to run. It is magnificent over there. I'd like to say ours is more magnificent over here, but I'm not allowed to do that because Alex is so downbeat on the UK. But anyway, in terms of what happens next in Africa, though, what do you see as the long-term story in Africa? You've got a long history there. This is a continent where the population is exploding right now, and I do wonder whether or not. I'd be interested to get your long-term take. We're going to talk about this in the next hour. What your long-term take is on the economic stability of Africa. What do you see happening?
It's absurd to generalize across a continent as diverse as Africa with a young population of 1.4 billion people. It's about the scale of an India or in China in population. But in general, the GDP growth in the areas where we're mining, if you look at Katanga, it's probably growing at 20% a year, and the GDP growth in the Congo is very high. So the metals that we need for electrification of the world economy are primarily going to be sourced in Africa. We can't mine in Russia or Ukraine. We can't mine in areas that are ecologically sensitive, where it rains or snows more than it evaporates because of the integrity of tailings ponds is called in question. Latin America is turning quite far to the left, sort of a Yankee go home philosophy. So it's really Africa that the world depends on to find the metals you need for any form of energy transformation.
So speaking of, with the IRA here in the U.S., do you anticipate copper being listed as a critical mineral I mean, it sounds like you think it should be. Do you think it will be?
It has to be. It's obvious. I had the privilege of meeting Amos Hochstein, who's responsible for this in the American government. He agrees with me. It's critical that copper be added to the list, as does the senator from Arizona, of course, where we are working on building a new copper mine.
So do you think it's going to happen, though?
Yeah, it has to happen.
Okay, it has to.
It has to happen because America really hasn't really developed a significant mine of consequence in the last 40 years. And the Democratic Party is now getting more favorable about copper for electrification and the greening of the world economy. The Republicans tend to more concerned about national security, but the mining of copper is absolutely critical to the very existence of this studio, these lights, these television cameras,
your phone,
and the development of the whole modern economy. So yes, of course, we're going to be mining in the United States.
Robert, let's talk a little bit about Africa again, though. You talk of it being the kind of the critical source for copper and many other minerals going forward. China has invested heavily in Africa over the last few years. Every time I've been there, I've been shocked and surprised by just how big an investment has been made. How is that going to play out? Does Africa look east or does Africa look west?
Both. If I were an African, I'd play everybody off against the middle. The Chinese can only be accused of being prescient and intelligent. They went to Africa 20, 30 years ago because it's very clear that they have to secure the supply chain for 1.4 billion people of their own. And now the West has to look to Africa, where we have enormous strengths and opportunities to offer a young African population. And so I think it's critical that America play to its strengths and also appear in Africa. In the last 10 years, I'd say the Americans have been present in Africa only by their absence.
Yes, full stop. Last question here. What does the copper price look like in 2030?
You'll be, if you go out and build your house out of copper bricks, the physical metal, and cover it with gypsum wallboard so you forget that it's there, you'll be able to tear your house down in 2030 and buy a fleet of Lamborghinis with a real profit.
So 20,000?
The copper price will do much better than holding the United States dollar.
So 15,000? 50,000?
Higher.
Higher than 50,000.
Higher in real terms. Higher. You know, we're measuring it in dollars. The dollars are going to shrink. We're near the top of the dollar rally. The Fed is raising rates. They can definitely engineer a recession if they want to. But when we go back to a normal world and they stop raising rates, I'm very confident that real things will be back in fashion.
Robert, we really appreciate it. There's so much more to talk about. We'll get you back on. Robert Friedland of Ivanhoe Mines, thank you so very much. All right, coming up, here's the deal. RTO or else. That is the message from Citigroup to staffers reluctant to return to the office. The finance giant says there will be consequences. We'll break that down next. This is Bloomberg.
I think we have done a superb job through COVID, all of us, to bridge it. But there is nothing which replaces personal interaction, and therefore I'm clearly working to get more people back into the office. It will be good for society, it will be good for the overall industry, it will be definitely good also for Deutsche Bank. But the most important is people need to interact, and therefore I want them to be back.
That was, of course, the Deutsche Bank CEO, Christian Sewing, speaking exclusive to me yesterday about the company's return to office policy. In the United States, they've taken a more clear line that you have to come back into the office. Citi, probably one of the more relaxed banks on Wall Street, but it is now making it very clear, and that will be made very clear as well during the process that staff are about to go through, that coming back into the office has an impact, potentially on pay, on conditions, all kinds of factors. And if you don't come back into the office, then that is going to have maybe the reverse impact as well. Joining us now to discuss this, Bloomberg's Wall Street correspondent, Shonali Basak. Shonali, Jane Fraser has taken a much more relaxed approach than many on Wall Street to return to office. Certainly, Citi has taken a more benign approach. Why is that now changing? I read the story this morning on the terminal. It struck me as being a fairly straightforward one. Come back into the office, things are going to work out. Don't come back into the office, and maybe as we go through this process, you are likely to see maybe a reduced pay packet coming your way. That seems logical to me. Is that now where we are?
You know, it's interesting that you mentioned this because for Citigroup, it's still seen as one of the more lax policies on Wall Street. Remember, BlackRock more recently told their employees 4 days a week, please, be in the office. We have a new office in Hudson Yards, and we want you all to be together. It's needed for mentorship. It's needed to do things faster, better, stronger in a tough environment. But listen, for Citigroup, it's still majority of the employees here 3 days a week. And so that is a little less than what you're seeing, for example, over at Goldman Sachs. So even with the lax policy, this is showing you that if you're not complying, there will be consequences. You can't have some people that are complying and others that take the rule a little less seriously. It just shows you, Guy, how much friction there has been in this kind of post-COVID world to get people back into the office, even for policies that are more lax than some of the other banks.
Yeah, I mean, when I read the story, I was like, well, duh. Like, if they want you to do something and then you don't, then you won't get comped in the same way. But is this like music to the ears of people that have New York commercial real estate offices in their portfolio?
Yeah, I mean, listen, it's been a really tough time for commercial real estate, and I want to point to the story that's on the Bloomberg terminal and one specific sentence that is just so beautifully written. It's the creeping rot inside commercial real estate is like a dark seam running through the global economy. And, you know, the reality is, if you see CBRE's global economist is telling you that it could take 10 years here for prices to reset in commercial real estate. There's also this reality here that not all commercial real estate is created equal. So even if you have people coming back into the offices, what does that mean for malls? What does that mean for multifamily housing? What does that mean for different cities where downtown Los Angeles may not be seen the same way as Canary Wharf or New York City?
Shonali, do we know what the spread's going to be between those that do come back and those that don't come back when it comes to comp?
When it comes to compensation, you know, it could be pretty meaningful for a couple of reasons here. Because if you think of the derivative effects, if you're sitting next to your boss and your boss is handing you an assignment, then you're on a bigger deal potentially than the guy that didn't come in. And so that's not directly whether you've come to work or not, but you are seeing rewards happening here in different ways. I would also say it's not just coming back into the office. You have all these banks and big financial institutions flying around the world as well. I know there's a lot of money managers, for example, right now in Korea, and they're all staying at the same hotel, and they're all you know, doing business together, and they expect their LPs to be there in person as well as the executives and their deputies as well. So, you know, this is a matter of getting back to work, let alone getting back into the office, given that a lot of these folks are anticipating some tough times ahead.
Yeah, although, you know, I talk to some younger kids and they're like, nah, it's okay. I'm not motivated by money in the same way, so it's very confusing.
Around now too.
Exactly.
How many of them have jobs coming out?
Yeah. All right, Shonali, thanks a lot. Really appreciate it. Shonali Basak joining us there. This is Bloomberg.
The relationship between the United States and India is will be one of the defining relationships of the 21st century. Two proud nations whose love of freedom secured our independence, bound by the same words in our Constitution. First three words, we the people.
That was President Biden on the relationship between the U.S. and India after his bilateral meeting with Indian Prime Minister Narendra Modi yesterday. And defense and technology deals were signed to help improve ties between the nations. And later this afternoon, President Biden and Prime Minister Modi will have a lunch with Vice President Harris and Secretary of State Antony Blinken, followed by a community event in Washington. Now, the goal is a long-lasting relationship. Now, the two nations do have a history of announcing cooperation agreements that failed to materialize. So that's one big story we're watching. We're also watching a couple ones here. This is an interesting one. The defunct Bed Bath & Beyond retailer may actually get a new lease on life, at least on the internet. The home goods store that filed for bankruptcy back in April has accepted over a $21 million bid from Overstock.com to acquire its digital and intellectual property assets. Overstock shares are rising a bit, but remember, Overstock got a big bid when COVID happened, and then now it's kind of petered out a little bit as people stop buying stuff for the home. The deal has to still be approved by bankruptcy court, and the sale will not include the Best Buy Baby brand. That's hard. Buy Baby brand. Fair enough. Okay, finally, here's one that I'm very excited about. Drinking in style. The luxury conglomerate Moet Hennessy is opening its first ever cocktail bar tomorrow in the heart of Paris' Saint-Germain neighborhood. Can I visit it with my 9-year-old? Now, the 5-story emporium will be called Crevin, named after the avant-garde poet and artist Arthur Crevin. The space will include, check this out, Guy, a bookstore, reading room, marble fireplaces, rooftop space that doubles as a movie theater. And as far as on the menu, you got brands like Dom Perignon, Veuve Clicquot, Moet & Chandon, and they're all like good mixed ones. Like you can get a nice Ruinart brew with basil flowers. It sounds kind of good, doesn't it?
Yeah, absolutely. Don't take your daughter, do take your husband, I think probably is the story
So
here.
leave her outside?
This is basically, well, I'm sure you can figure something out. Maybe she stays on the first floor and you go all the way up to the 5th floor. The 5th floor, I understand, is invitation only. I'm sure you will be invited in. But yeah, no, it sounds quite nice. What surprises me is that it's not members. It's not a members club.
Right.
I thought when I saw the story first thing this morning, I thought it was going to be a members club. The top 2 floors, though, I think, by invitation only. I'm not entirely sure how you are going to get an invitation, but I'm sure we're going to work on it. It's going to be very important.
Yes. We'll work on that for next year for the Paris Air Show.
And maybe they do mocktails. Maybe we can figure that one out. Let's talk a bit about European markets. We're coming into the end of the day. It's been an ugly week. Stock 600 down. The euro's under pressure, down by 0.7%. The German 2-year obviously absolutely flying today on the upside. Hugh Hendry is coming up in the next hour, folks. It's going to be an exciting end to the week. Hugh is going to be joining us very, very shortly. This is Bloomberg.
answers, great questions.
Friday, the 23rd of June, ugly session for European equities, ugly week for European equities. Big day for the bond market, though. Huge move in yields. The countdown to the close starts right now.
The countdown is on in Europe. This is Bloomberg Markets European Close with Guy Johnson and Alex Steele.
So ugly day for European equities. It's been a terrible week, to be honest. We're factoring in central banks that are likely to raise rates more than we anticipated. We're now factoring in data that shows us that the European economy is slowing down fairly rapidly. European stocks down by 0.2%. We're off the earlier lows. Siemens Energy is down pretty hard. I hope that's the right stock. I think it's the wrong stock. But anyway, let's not worry about that. Euro dollar down pretty hard. Siemens Energy is down today. And the reason why Siemens Energy is down today is that we are seeing basically guidance being withdrawn and effectively a profit warning coming through. We have a problem with wind turbines, Alex. We'll talk about that in more detail later on.
I think Siemens still counts because they still have some equity in Siemens Energy. That's going to make it harder now for them to sell down. Here in the U.S., it's also kind of ugly. We're down about 0.7% on the S&P, but for the whole week, we've seen the biggest loss so far for the S&P since back in March. So we're definitely seeing pressure on global equities. Over $5 billion was taken out from global equity funds. I'm paying attention to dollar-yen, not just for dollar strength today, but also the yen weakness situation. So we're nearing levels where we had an intervention before. 143 was kind of that level. Do we get to 145? Do we get verbal intervention? Someone pointing out earlier that it's also dollar weakness and yen weakness overall for this week. So it's been a rough go. Where do you put your money? So you put it into gold and you put it into the bond market. The two-year yield not really moving that much. It's really over in Europe in particular on the back end where you're seeing a lot of buying. But nonetheless, that's where we're seeing the money flow. But all week as well. Commodities get hit except for gold. You got crude up by 1.4%. It's been a pretty ugly week for the crude market. This is the biggest weekly loss. It looks like about more than 4% so far right now. It just speaks to what Guy's going to talk about, which is the PMIs, the growth. The recessionary fear is becoming the problem.
So ugly. The data today, so ugly and way worse than anticipated. The Eurozone data, in particular, the UK data doesn't make particularly pretty reading either. And this points to a significant slowdown. What I think is crucial in what we're seeing right now is, yes, manufacturing has been rolling over for a while and the German numbers are really bad, but there's the service data we are now seeing coming under real pressure. France has been hit by strikes. That's certainly a contributing factor into all of this. But look, we have a Eurozone services PMI that comes in at 52. The composite number comes in at 50.3. The manufacturing number's at 43.6. That's an ugly number, Alex. And we are rolling over fairly sharply. The survey data is pointing to a significant slowdown. The central banks are telling us they're going to continue to raise rates. That is a difficult tension for markets to factor in and think about.
Yeah, exactly. And how bad does the data have to wind up getting and where the mistake is? So Chris Williamson spoke with us. He's the man behind the data in the last hour.
Some very disappointing numbers, as you say, across the board, most notably in Europe. We're seeing growth weaken. So in terms of policy mistakes, I mean, policy is designed to make demand weaken, and that's exactly what you've got, plus a bit more possibly. Eurozone growth is stalled in June, and it's weakened quite markedly in both the US and the UK.
So that brings us to our question of the day. Are PMIs, the data we saw today, pointing to a policy mistake? Joining us now, Bloomberg's Christine Aquino and Noor Al-Ali. There has been collusion between these two. They are going to take different points of view. Let's figure out what they are. Christine, I'm going to start with you. Are the data pointing to a policy mistake? Should the central banks be raising rates from here?
Well, Guy, I think it is pointing to a policy mistake, and I think the data is telling them that maybe they're going to have to reconsider those rate hikes that they're signaling at the moment. I mean, definitely when it comes to the UK, I mean, I've been tracking that story very closely.
Yep.
What we're seeing in the markets is really quite incongruous with what we've seen from the central bank yesterday. Surprise 50 basis point rate hike. Where does the pound go? All the way south. Where do yields go? All the way south.
Hard landing coming, basically. basically. That's what the market's signaling.
Yes,
and that's what the data's signaling today as well.
Exactly, Guy. And so I think it really is rolling over, particularly in the UK. But as you mentioned, that's happening in Europe as well. And, you know, I think the problem that the ECB has in particular is that it was really late out of the gate. It was the last one of the major central banks to deliver those rate hikes. And that was always going to be the problem for the ECB, right? As hawkish as Lagarde wants to sound, it's difficult for her to stay that hawkish when the rest of the G10 gang are kind of thinking about either pausing or even rate cutting.
Okay, Nor, you disagreeing here? PMI is pointing to a policy mistake?
I don't want to point to collusion between us, but yes, I'm going to disagree here, of course. Well, mostly because policy is doing what it's meant to do, right? And we're starting to see the PMIs react. You know, those delayed effects of rate hikes really starting to come and manifest themselves. So I would say let's try here and maybe celebrate, because if you do see here that inflation has been coming down, and that is a point for celebration for the ECB. Now, obviously, I say celebration with, you know, not even a spark of salt, but a whole bucket of it, right? Because it does point to a lot of strain on the economy. But what it does show you as well, that interest rates work. The ECB's job is to tame those demand expectations as we had from the S&P Global Guide before, and that's exactly what they're doing. So July, absolutely in the bag. We know there are going to be rates there. September, perhaps now that's up for a greater debate.
Alex, I guess we should probably also define what a policy mistake is. What does a policy mistake actually look like? And I've been thinking about this. I guess we won't know until it happens, but it would be the labour market getting out of control. At the moment, we've got a super strong labour market, but if unemployment suddenly rockets higher, that could be a policy mistake. But the labour market looks really strong at the moment. So if you don't see that labour market tension, can it be a policy mistake?
Right, which, Christine, kind of pokes holes into your side.
Yeah, exactly. I think for me, the definition of policy mistake is basically anything that kind of forces central banks to U-turn on the current track that they're on, right? So basically anything that gets them to reconsider those rate hikes and maybe start thinking about, again, what we're seeing from the Fed at the moment is pausing and maybe prolonging that pause, or maybe even starting to think about rate cuts at this point. And so really that's what we're kind of watching.
So if they pause, it can't be a policy mistake. So if there's an extended pause, it's not a policy mistake.
Not necessarily, because they haven't quite capitulated on the current track that they're on. So for me, I think you would call it a mistake when they suddenly U-turn and say, actually, we made a mistake, we shouldn't have had all those rate hikes that have now threatened the economy to this extent that we suddenly have to pivot very quickly and cut rates. So this, I think, is a scenario that central banks want to avoid. I just don't know if they can actually avoid it in the case of some of the G10 central banks that are later out of the gate.
So I guess the question also becomes is how much harder is it going to be to bring inflation down from here? I mean, we take a look, Nor, say at the factory prices, they are easing, right? The services that they're charging are easing. Input prices for services are still rising, but like it's happening. And it's like the next leg then, Nor, that becomes the problem.
Yeah, absolutely. Second round effects, definitely the big debate and the big theme that we're going to get into the next half of this year. And also keep in mind the impact that this is having on commodities. I know that, you know, central banks are particularly tied to basically the impact on the economies, but let's not forget you have increased or expected increased demand out of China coming out with their recovery and their stimulus. Also in Japan, they're talking about stimulus. It's a completely different situation there. But also you had the PMI figures point to that kind of global, you know, the global theme that we've seen earlier today. We've also had that from Australia. So technically speaking, we're at a point here where I think pausing those efforts from those central banks, that would definitely be a mistake. I think it's Godspeed ahead. Wait and see what happens. Second round effects, we always knew they were going to come, Guy. We always knew
that they were going to come. And I think the really tricky thing that central banks are dealing with this time around is, A, they're dealing with the pandemic, which is having a kind of effect on what normally would happen. And also policy is working with a much slower effect. The Bank of England's experiencing this. All central banks seem to be experiencing it at the moment. They're not getting the speed of transmission that they normally would. So when do you think we'll know if we've made a mistake or not?
Well, look, typically what we know in Economics 101 takes about 18 months to start feeling those.
Is that still true, do you think?
Look, I think we're starting to feel it in different ways, right? Because there were bottlenecks from COVID that had eased. The acyclical factors in the PCE, especially in the U.S., have really come down, but you've seen the cyclical come up. You've seen housing, really a big crisis here in the UK, a lot of questions about it in the U.S., and energy, obviously, that war in Ukraine really played a big factor. And don't forget, we had Brexit here. So there's a lot going going on here. And don't forget, Guy, we still have the fiscal arm of things. Monetary policy doing what it's supposed to do, but we still have the fiscal aspect of things that can come in and step up and aid those economies if there is need.
Dangerously close to how I categorize the UK economy sometimes, Guy. But to Nora's point, and I know that I'm putting this back in the US for a moment, but if you take a look at areas like housing, has that already had its hard landing, and have we recovered, and can it actually accelerate? The home builder index doing relatively well. You could say the same thing for some of the cyclicals and the industrials. Apple yesterday hit another record high, so it's hard then to make a lot of hay about the data and say a 1% sell-off in tech that we're seeing.
The housing market, I think, is a really good example, a really interesting example, because I think it speaks to a wider issue that I think we're still challenged with. We have a supply side issue that we're trying to deal with right now. Housing is a classic case in point. The UK Nor brings up what's happening with Brexit. That in some ways is creating a supply side problem as well. All of these are not very good problems to solve with monetary policy. You basically have to kill demand. So is the policy mistake that we're trying to treat the symptoms that we're experiencing in terms of the inflation we're getting with the wrong medicine, Christine? And maybe that's the policy mistake we're making, is that we're overdoing it because we can't solve the problem on the supply side with monetary policy.
I think you're absolutely right, Guy. I mean,
say that again.
You're absolutely right, Guy. Let me just say it. No, but I agree. You know, I mean, interest rates, it's a blunt tool, but it's really the best that the Bank of England has got. And I think they, to some extent, have also admitted that it's not the perfect solution to the issues that are facing the UK at the moment, because it's not just demand side. It's actually not demand side inflation that's kind of pushing up prices at the moment. A lot of it was a factor of external issues, the war in Ukraine, what's been happening with commodity price and whatnot, but it's still an issue that they have to deal with, and the best only tool that they have, is raising interest rates at the moment. And, you know, I think what they're bracing for is to what extent that kills demand, and to what extent does that force a U-turn, ergo a policy mistake, where they're going to have to suddenly cut rates because the economy just can't take it any longer.
Yeah, and Chris was warning about how the travel boom is going to end after the summer, and I remember recalling I heard that exact same argument last year at this exact time. So I am still worried that, I am still curious if that actually is ever going to materialize. All right, guys, good combo. Thanks a lot. Christina and Nor, we really appreciate it. Thank you for joining us on this Friday. All right, coming up, Guy will be right again. Get more insight into our question of the day. Our PMI is pointing to a policy mistake. We're going to ask Kiran Ganesh, multi-asset strategist over at UBS. This is Bloomberg.
Janet Yellen, the Treasury Secretary, currently giving an interview to the Wall Street Journal. Probably worth bringing you some of the headlines. Janet Yellen saying more bank mergers are likely this year. Watch this space. More consolidation in banking could be healthy. The US has a significant number of small and mid-sized banks. Are we going to see significant consolidation? The Treasury Secretary may be signaling that she would welcome that. Let's get back to our question of the day. We've already had a lively debate around it. Are the PMI data that we are seeing right now pointing to a policy mistake from central banks? Kiran Ganesh, Global Head of Investment Communications at UBS, joining us now. What do you think?
I don't think it shows that they're making a policy mistake. Inflation is still very high, and it in fact shows that the interest rate hikes they have done so far are starting to have an effect. And actually, if the economy stays too strong for too long, that just raises the risk they're going to have to increase interest rates even more. So I think that is probably the bigger risk for markets. A slight slowdown in terms of those PMIs is probably not such a bad outcome for markets today.
So do you agree then? Sell stocks, buy bonds? Like, that's the playbook, right? Let's leave out the UK for a second. In that scenario, is that the case?
Yeah, so we prefer bonds to equities today because you think you've got a nice combination of a decent yield, and those bond yields should decline in the middle to the longer end of the curve as we start to price in slightly slower growth. So we think that it's better to be in bonds than equities today because equities are not going to like this uncertainty and this combination of slowing growth and uncertainty about the path forward for interest rates.
Do you wait, though? Is there a better opportunity to get into bonds? Are central banks going to have to go further? Or do you just say, you know what, today looks pretty good, it may be better further down the road, but if we do see economies hitting a wall, we're going to see yields coming down pretty sharply?
Yeah, at the short end of the curve, I think there is a lot of uncertainty, like exactly where is the ECB or the Bank of England going to peak in terms of interest rates. There's a lot of uncertainty there. We're more focused on the 5 to 10 year segment where we are much more confident that yields will start to fall by the end of the year, because either we see interest rates at the short end.
By how much? How much do you think we're going to see?
So we're looking on the US to around 3.25% by the end of the year, so around about a 50 basis point decline on the 10 year. So reasonably substantial fall by the end of the year.
Just to focus on the UK for a second, the market and terminal rate is now pricing at about 6.25%. We haven't seen that kind of rate since 2008. Do you think that the UK goes there, and then is that a divergence play, the UK and kind of everywhere else?
Yeah, so we have been looking for the UK to rise to around 5.25, but sorry, 5.75. Obviously, given the data and the Bank of England's commentary, that probably needs to be revised up. So it is looking increasingly likely the UK could go beyond 6% in light of some of the data we've had recently.
Do you think the demand? I'm wondering kind of. I can see what you're saying by the end of the year. No, I'm just trying to process and think about what he said, and then I'm going to hopefully ask a smart question. But we'll see. In terms of what we're seeing in the bond market right now, is it a real reflection of where rates are going? There seems to be a significant amount of demand for 2 years, for 10 years. Are we going to see that demand continuing? Is this going to be a story of more and more money coming out of money market funds going into the bond market, not going into the equity markets? I'm wondering what's going to fuel this rally.
I think that very much is the story, because people have been sitting in money market funds quite happy to earn these higher and increasingly high interest rates at the short end.
So they're just going to look for duration now to lock
Now they'll be starting to think, what's going to happen over the next 5 years? Surely there's going to be a recession. Surely there's going to be deep interest rate cuts in the Eurozone and the UK at some point over that time period. I need to lock on that yield, and we think that will fuel a further rally for bonds.
So what stocks then feel the most pain in that environment?
So technology, we think, will suffer. That's obviously rallied very, very strongly so far this year. It is very interest rate sensitive. Valuations have run far ahead of where they should be based on where real interest rates are today. So we think that is one area that will suffer from those higher interest rates in particular. We're more focused on the defensive parts of the market, so looking at consumer staples and utilities. Yes, a little bit interest rate linked, but we think that they will do better in a slowing economic environment.
Does Europe outperform, or does the US outperform in this environment?
So Europe's somewhat. Our preference globally is for emerging markets, then Europe, then the US at the bottom of the pile. So Europe has got reasonable valuations, but they're still having this challenge with increasing interest rates, inflation. In the emerging markets, they increase interest rates much more aggressively early in the cycle, and they're now actually starting to look at cutting interest rates in places like Brazil, and we think that that will be a stimulus for the EM.
How bad does it get in the UK at an economic level? Sorry, I'm leading the witness on that one. Just in the relation that you're kind of talking about, UK, EM, etc., where does UK fit on that scale? Considering if we look at over 6%, that's going to be really brutal.
Yeah, so for the currency, we don't think it's so bad. So if investors are holding pounds relative to US dollars, we think the pound will appreciate against the dollar because you're likely to see the UK interest rates moving much higher than where we are in the US, where inflation does seem to be coming a bit more under control. Now, from an equity market standpoint, it is a defensive market, but the pound strength would be a headwind. So we're neutral on the UK at the moment from an equity market standpoint.
FTSE 250 versus FTSE 100. We were talking about this earlier on in the program. Are we going to see the miners coming back? Are we going to see this China play that has driven the French market, LVMH, the luxury stocks have done so well? Is that going to flip into Europe as we start to see China sort of stimulating? If we think about how Europe is going to go from here, are we looking the wrong way? We should be looking at China rather than the United States for our guide, our signal as to what is going to happen.
Yeah, so generally we'd prefer the 100 versus the 250 just because it's more international exposure versus UK exposure in the economy. But if there are select names in that 250 where you're getting that exposure to perhaps commodities, to some of the base metals, to some of the transition metals which are in that 250 index, then we see some select opportunities in there.
When does the consumer crack? Because I feel like that is the question that will then dictate when everything else winds up shaking out. And is there one area where we crack further? I mean, Guy was pointing out earlier that even with all this high inflation and the central bank over in the UK having to go really hard and really high, you're still seeing retail sales okay, consumer confidence okay.
Yeah, it's a big puzzle how well the consumer has held up for so long. It obviously takes time for interest rate increases to filter through into the economy, and we're seeing lots of headlines now about the impact of mortgage increases, so that could start to crack the consumer in Europe. In the US, I think it's a lot more uncertain because, of course, the US, they have been drawing down savings, but at the same time, now real income growth is positive in the US, so that means that consumers can continue to spend, meet those price rises without having to dip into savings. So in the US, we think the consumer could prove to be a bit more resilient.
Yes, that's what I've been telling Guy. All right, guys, thanks a lot. Really appreciate it. Karen Ganesh of UBS, we appreciate your time today. Happy Friday. This is Bloomberg.
It's Friday, the sun's out, here in London at least, and it's time for last order. So let's take a look as we wrap up the week what European stocks are on the move. I want to start off with GlaxoSmithKline. The stock is up by 4% over the last couple of days, most of that coming first thing this morning. The reason for that, GSK settling the first of the major Zantac cases, cancer cases that have come through. The market's seeing that as being removing a really big overhang, and the market responding very positively to that. One of the big stock stories on the FTSE 100 today. House builders in the UK under pressure. The mortgage story front and centre. HSBC out with a big note a little bit earlier on, talking about the fact that you are going to see a brutal squeeze on this sector. We'll move the stock on and we'll show you that in just a moment. So Barclay, one of the ones under pressure, but there are others as well. That stock, as you can see, down by 2.71. The price target really significantly removed. We're trading at 37. They're talking about 30. And I want to wrap up on Siemens Energy. Withdrawal of guidance and a profit warning this morning. The stock reacting in a brutal fashion, as you can see. 2 days, 36%. Big gap lower first thing today. Alex, what they're really talking about here is that they have had... Gamesa got taken over by Siemens effectively, and they've been dealing with this ongoing issue of quality control, and they keep coming across issues, and as a result of which they just can't get through the problem, and it's going to take longer. Long term, they still think it's the right decision to take that business over and deal with these problems, but it's not over yet.
No, it's definitely not. And it's interesting as to all the factors as to why. Like, one of it seemed to be definitely an operational issue when it came to Siemens Energy that sort of got sucked into the strong demand that we saw during COVID. But the other is a true issue, which is how do you scale up and not make it too expensive? Now, you could look at the absolute cost of wind. Sure, you could say, okay, it's cheaper than oil and gas, but you still need storage, you still need all the stuff to build it. Then there's the whole how do you recycle it issue. There's a lot of other questions that have yet to be answered in this space as we quickly transition.
And how do you write the contracts and make sure the contracts are reflective of the reality of building this stuff?
Yeah.
That is a huge problem. But I think the biggest problem with this industry remains permitting. Actually finding where to build this stuff and then plugging it in, connecting it to the grid. Those are the two major problems that we still face. But yeah, building it profitably is going to be a major challenge. And as Siemens Energy is proving, it is going to be an ongoing one. You would thought that this would be an absolute home run. Building wind turbines right now, setting out to be much trickier than we anticipated. We're going to talk about that next. We'll show you the close coming up. We've also got Colin Coleman joining us. Looking forward to that conversation. Hugh Hendry's about to join us as well. This is Bloomberg.
that all day yesterday.
Ugly end to an ugly week for European equities. European equities down pretty hard today. The catalyst for this session has definitely been the PMI data, because we've had a week when we've been focusing on rising rates. Now we've had falling rates, but the story is one of maybe a slowing economy and a rapidly slowing economy. And are we going to see a policy mistake? That's what the market is dealing with right now. Equities come softer. CAC's down by 0.6%. The DAX today down by over 1%. London's down by 0.6%. So we are seeing a continuation of the selling. The move in the bond market is extraordinary. So you've had a week in which we've been talking about higher rates, yet what we see today is a bond market bid. So rates go lower. This is the story over the last 5 days. As you can see sequentially, day after day after day after day after day, we have lower sessions. Haven't seen that for many weeks. I think the last time we saw this was in March. We've seen 5 sequential days down. So we haven't seen this for a while. So is this a turning point? Are we going to see maybe this run-up that we've seen, this rally that we've been watching, starting to fade? And is this week the pivot point? So on the week, we're down by nearly 3%. We'll move that little box for you. This is what the sectors look like in terms of the week. Food and beverage, the best. Basically, you've got a safety trade that's come into play here. So food and beverage, the grocery sector, the two best performing sectors, but they are down 0.6%. Bottom end of the market, we go back to that city note this morning. Basic resources being battered this week, down by nearly 8%. Real estate off by 6.5%. Financial services, technology, autos, construction, all down by more than 4% this week. The travel sector, which is being hit hard today, is also down fairly hard this week. So that's the sector breakdown on the week. It has been broad-based selling, and it has been reasonably brutal selling. Today, let's talk about the session that we've seen. Siemens Energy down by nearly 40%. This is what happens when you, A, issue a profit warning, and B, remove guidance. The market really kind of looking at this and saying, we need to get out of this one and get out of this one quickly. We don't know when stability is going to be found. Glaxo at the other end of the spectrum, GSK up by nearly 5% today, settling the first of the Zantac cases. Huge overhang removed. That seems to be a real positive for the market. But travel stocks in particular today have been under real pressure. And this points back to what we're seeing in the PMI data as well. Air France down by 5.5%. So Ben Smith having a tough day. Gallego having a bad day over at IAG. IAG's down pretty hard as well. You're seeing TUI down hard today. So that kind of consumer-related story coming under real pressure. In terms of what we're seeing for next week, because that was the week that was, we are going to continue obviously to deal with the data. Monday we get the IFO numbers out. That's going to be telling. That's kind of a really important piece of data for a German economy that looks like, judging by today's data, that is slowing down. We get consumer confidence out of Italy. Sintra is underway in Portugal. This is the gathering, the ECB gathering. Got some really big speakers coming up sort of Tuesday, Wednesday. Wednesday, the main day. You've got a whole range of names that we're going to be hearing from. Jay Powell's going to be there, Christine Lagarde's going to be there. So you've got a whole range of names that we're going to be listening to. Then we get back into the data. Spanish and German CPI data. Friday we get Eurozone data as well. That's going to be a real tell on whether or not this idea that central banks are going to continue to push hard, regardless of what they're seeing in terms of the soft data, they're going to continue to push with the rate hikes. I think that's going to be a really big day. This time next week we'll have that number, Alex, and I think it's going to be really important.
Yep, and also the end of the quarter and the end of the first half of the year too, which is going to confuse sort of market reaction function to that as well. We talked in the last hour about Africa, particularly South Africa, and operating there and what the difficulties may be. Now, Zambia had just reached an agreement today to restructure its $6.3 billion in debt. Bloomberg's Jennifer Zabasaja spoke with Zambia's president earlier today.
To get everybody to the table, to then negotiate plus minus what Zambia expected, what creditor A expected, creditor B, creditor C, was the most difficult thing. Now we're here. The next is consummation. Simple, straight.
France has signed up. China's signed up. They basically led this move. Doesn't have legal binding at the moment. Obviously, we're going to see the Eurobonds being negotiated. Well, that probably is the next step. But this is maybe emblematic of something that we are going to be seeing a whole range of countries going through and maybe precedent setting in terms of how the process is going to unfold. Let's talk to somebody who has significant experience and knowledge of the region. Colin Coleman, former partner and CEO of Sub-Saharan Africa at Goldman Sachs, now a fellow at the business school at INSEAD. Colin, great to see you. Haven't seen you for ages. Look, Africa has many challenges right now. We're seeing the Zambian debt deal being done. Are other countries going to be forced to follow?
Well, we've seen Ghana as well. It's great, by the way, to see Zambia's debt being resolved through global cooperation. It sounds very much like European Union led by France and China are involved in these debt negotiations, and that's very positive because we're going to see significant amounts of stress in the African financial markets who've taken on Eurobonds over the last decade. As interest rates rise, debt costs rise, and the economic growth in Africa has not risen with